50-hour training program. And you'll all be completing this valuation training course today. And then the real time will start, where now you have to start preparing on your own for the exam part. And I believe that within next 15 to 25 days, you will be ready for the exam. Yes, so I hope everybody is now geared for an exciting 15 to 20 very cumbersome days, because you have to work and then prepare for the exam part. So today what we are going to cover is valuation under specific situation, where we'll be trying to cover how to do valuation under stress asset, the startups, the small and medium enterprises, and then valuation of intangibles. So a lot of things to be covered today within a short frame of time. And we'll be solving a lot of questions also on the screen. I hope my audio and video are clear. Good. So we'll start with the concept of valuation of intangibles, where we'll understand that what are the types of intangible, and as a valuer, how do we value these intangibles? Though obviously, whatever we have studied so far, that is the various approaches for valuation. The concept would remain same. There's no such difference in the concept, but maybe there'll be some changes in the approach in terms of calculation part. Other than that, I think the whole concept will remain same. Okay. So intangibles, friends, when we consider yes, when we consider this world of intangible, then obviously there are some basic things which comes to our mind is the brands, the trademarks, and the royalty. Normally, these are the things which comes into our mind when we consider this world of intangible. But let me tell you, friends, the world of intangible is something beyond that, more than that, and we'll understand that what are various types of intangible and why valuation of intangible is required, and then the various methods of intangible. To start with, the biggest problem comes in is to identify the intangible. And why do I say that it is very difficult to identify the intangible? Because we don't know what is that thing which is working for us, friends. Very important. Is that how do you know that is it your brand which is working for you, or is it your quality of work, or is it about your customer, or is it about your location, or is it about anything else, which is working for you? And that is why corporates around the world are trying to identify that why is their business, what is the reason, apart from obviously the product nature and thing, these are the common points, but then there is something beyond that where we can demand the premium from the customer. So identifying the intangible is the biggest problem. And as a valuer, our job is not to identify the intangible. Our job is to value the intangible. So the management will take a call on what is that intangible which is there in their balance sheet, and then accordingly we have to value. In terms of exam coverage, around 5 questions could be asked from this particular topic, and you can refer the International Valuation Standard and the ICI standard along with the technical guide on the valuation, which has been issued by ICI in 2018. I would always suggest that you should always go through this technical guide on valuation, because it is an exhaustive document material which will cover a lot of aspects, which is included in the ICI standard. But other than the ICI standard, there are certain important things which are relevant for exams. So please do go through this technical guide on valuation, which is very important for the exam part. As a registered valuer, I think we need to understand that the intangible has got a lot of value, and we need to convince the management that we should always try to bring that intangible on the balance sheet, because it has got a lot of benefits when you recognize the intangible in your balance sheet, because the power of your balance sheet increases, and later on when you want to take any action of acquisition or selling of the business, and if you have recognized the intangible in the books, probably you'll get a better realization. So the intangible has got a lot of worth, and the people today, let's say in the Indian context, people don't understand the importance of intangible, and they don't break it on the books of accounts. So time has come where the intangible has to be recognized, so that the value creation is there for all the stakeholders. A small comparison, the not in terms of the content, but the number, the ICRVO is 302 and IVS is 210. So we'll be going through this the valuation standard. Both the standards will talk on the same line. There's not much of difference. Maybe 1 or 2 points may be different, but then I think broadly the concept is same in both the standards. So friends, we'll be covering the nature and the classification of intangible, the purpose, and the various approaches along with few practical examples. So as per the definition in ICI-RVO and IVS standard, the intangible asset, exam relevant point, friends, you can note it down. These are exam questions. It is identifiable. First point. Non-monetary, second point. Third, without physical substance. 3 important points in the first line. And we all understand what does monetary means and identifiable means. Then the next point, it can be developed or acquired, which we all know. Then the last point is more of a conceptual part where, see, normally intangible and goodwill go hand in hand. They can be interchangeable in a common parlance. But when you want to, book it in the books of accounts, then goodwill is termed as more of a generic term. And that goodwill will include everything in the sense, all types of intangible. So goodwill is a generic term. And after identifying all the intangibles, whatever remaining will be part of the goodwill account or the classification under goodwill. So to give you an example, let's say there is a purchase consideration which you have paid 100 crore to purchase a company, and that 100 crore is paid because of the land, building, debt, and the working capital. So after adjusting of all the asset and liabilities, the balance remaining is 60 crore. Now this 60 crore is basically of the goodwill, of the intangible. But this goodwill intangible will include something more. So it includes the value of brand, value of know-how, value of technology, value of trademark, value of non-compete agreement. And when we deduct and identify each of the individual values, and whatever balance is remaining, that is known as residual goodwill. So 20 crore is the residual goodwill. So what we can understand that goodwill, gross goodwill and a residual goodwill. Gross goodwill will cover all the value of intangibles, and the residual goodwill, where we cannot segregate individual intangible item, that can be termed as a residual goodwill. So goodwill in general means all the value of intangible. Why do we value intangible? I think the reason is very clear. That why do we want to value the intangible is because when we want to sell our business, including the goodwill, or we want to sell the individual intangible. Right? That individual intangible could be sold separately also, as we have understood in the basic concept. So that in that case, the tangible valuation would be required. Then I think the major change which has come in is with respect to the accounting standards, the Ind AS and the IFRS, and which calls for accounting for different angles of the intangible in terms of business combination, where there is a merger and acquisition. Then we need to identify each individual intangible and recognize it in the books of accounts. And that is why the need of valuation of intangible came. And then after that, we need to impair the intangible. So I think the more purpose is to have a proper accounting of all the intangibles so that the true reflection or true and fair opinion, true and fair reflection of the accounts is justified. So accounting has been the source for this particular concept of valuation of intangible. Then apart from that, we have taxation issues. We know the concept of slump sale, where these assets are sold in lump sum, and when it is done, it will include the value of the goodwill also. So in that case, I think the valuation of intangible is done. In a lot of cases, for under litigation, to identify what is the amount of asset, the amount paid, I think in a lot of cases we do need the valuation of goodwill. So under litigation for the compensation for breach of rights, the valuation is done. Then if Akshay Kumar wants to take the insurance policy on his own personal basis, then we need to identify the value of the brand, the value of the celebrity. So in that case, this valuation concept will come in. And at last, the sweat equity shares, where we know that the sweat equity shares are issued under company law, and these are issued because of the effort made by that person on the know-how IPR which they have been trying to develop.
Excuse me.
Yeah.
Sir, you have written the DEP on goodwill. Is it depreciation on goodwill?
Yes, yes.
So could you please clarify what is that? How goodwill is depreciated? What is there any methodology? Is there any methodology?
Impairment. Same as impairment.
Okay.
Is my presentation visible?
No. Yeah. And right now it is not there.
Yeah. So in case of sweat equity shares, again, the valuation of goodwill or the intangible would be required. So the purpose is multifold, friends. From here, we understand that valuation of intangible has got so many reasons, and therefore it justifies to be in the profession of valuation, because we will get a lot of opportunities in times to come for valuation of intangible. And because now people are getting aware, people are getting educated, yes, that intangible is one of the criterias of doing a business, running a business, the sales are generated, and therefore people have started recognizing it in the books of accounts. So a few questions on the screen, and let us have the answers on the chat box. So people are now conceptually clear that how is terminal value calculated and what approach do we need to follow. Good. Yes, Gordon is the correct answer. Next question. Good. All of the above. Absolutely correct. All of the above. Yes, I think D is the correct answer again. The above. Yes, again, all of the above. Right. Now, after understanding that why intangible asset valuation is required, let us now go through the various types of intangible asset. As I started the lecture, that the intangible is not only related to the world of the brands, the know-how, and so on, but it is something beyond that. So, if you want to categorize the types of intangible asset, so we have five categories, and to recall it, to make it more simpler, remember the word CAT-CM, where CAT will stand for contract-based intangible asset, artistic-based intangible asset, technology-based intangible asset, and the customer and the marketing part. So CAT-CM is the mnemonic which you can create, or any other mnemonic which you can create. Five categories of intangible asset. So now we understand that the intangible asset has got a broad spectrum. The variety is huge, huge in the sense the number of intangible is large, and we can count. If we start counting, probably it will go in 20s, 25, 30 types of intangible which can be recognized. So let us classify all these types of intangible asset and understand that how do we differentiate between the different five categories of intangible asset. So the first is marketing based, which will tell us that the intangible which are primarily in the used in the marketing or promotion of the products. That could include the trademark, the trade names, the trade design, and internet domain name. So these are all examples of marketing related intangible asset, which is working for the company. So maybe you will not be knowing the person behind the company, the name of the company, but you are aware of the trademark of the company. Let's say, for example, how many of you know that by what name Amazon operates in India? By by which company name? Right. So Mr. Vijay and Saurav has mentioned it correctly. So it is Cloudtail. Now, most of the people don't know it is Cloudtail, but people know the word Amazon. So that Amazon is the internet domain name which is working for the company, and not the company itself. So therefore, for Cloudtail, if you want to value the company Cloudtail, we need to value the internet domain name Amazon, and that is the importance of the marketing related intangible assets. The next is customer. Now, customer related intangible assets include, anything which is generating sales, extra thing for the company because of customer contracts, maybe the contractual customer relationship, the customer list. I think these are all reasons why your business is growing. So if you let's have around 200 clients, so obviously the 201st client will be there because you have 200 clients. That is what it is generating the business. It is increasing your business because you have a good customer list and you have a long-term contracts with this customer. So these long-term contracts will actually enhance your business, and therefore we need to value those customer contracts separately, and that is the intangible which is working for that company. If that customer contract would not have been there, probably you would not be able to do the business as easily, smoothly as you have been doing today. So that is why we have customer related intangible assets. Then artistic related, I think this is very common, which we all know. Any rights, right to benefit arising because of some copyright And that copyright is because of something you have written as a book, you have written produced a movie or music or plays. So all anything which is related to artistic related, which can generate an intangible value for you, that is an artistic related intangible. Next is contract related. Then, so contract related, I think we all businesses have a lot of contracts which give them extra benefits over a period of time. Uh, the the contract related maybe in terms of royalty agreement, licensing, lease agreements, broadcasting rights, or natural resource rights, non-competition agreement. These are some examples which give an extra benefit to the company because they have got this contract and the agreement. If these contracts and agreement are not there, then the company would not have been the current state of business. So that is why we need to separately recognize this value, the value of all these contracts. How this value will be recognized, we'll see. But first thing is identifying that intangible. Now, that is the essential part. Until unless you don't know the intangible, why do you need to value it? The last is again very common is the technology-based intangible asset. And we all know that technology-based intangible asset is related to the patented technology, the formula, the designs, the software, the processes, in the recipes. If the Sanjeev Kapoor is able to create the recipe, then he can patent that particular technology. Right? So that is also one of the intangible assets. And databases, friends, again, a huge valuation could be done for the databases. And we all now understand that database is equal to profit, database is equal to new oil, data is the power. So today a lot of stress is given on the valuation of the databases, and we have seen so many companies today are being valued at such high price because they have got a lot of databases, and they can use that database information for generating more business. So friends, now we understand that intangible word is not only related to the brands, technology, know-how, IPR, trademark, but there is a lot behind the scene which is working for the company. Let's shoot out some questions and let's see how many of you have been able to capture the concept of different categories of intangible assets. Yes, so C is the correct answer. Next one. Yes, so I think that's the correct one. B is the correct answer. Next. Yes, correct. Trademark is the correct answer. Yes, technology related is the correct answer. No, it is not D, sorry. A is the correct answer. A is the correct answer. Marketing related. Right. Next one. Lease agreement is the correct answer. Correct. A is the correct answer. Yeah. Next one. Simple one. Everybody should get it correct. Artistic related is the correct answer. Next. Right. So next one. Simple one. This contract based is the correct answer. Next one. Yeah. So technology based. So now what we have understood is the various categories of intangible asset and the type of questions which are going to come. Probably out of all these 12 questions, I'm sure one question will definitely come in the exam. I'm sure about it. So very easy, not much of technical part till now. But now let us go into the technical part in terms of the practical ways of valuing the intangible and understand the various methods. Again, probability of a practical question coming out of this topic very low, and I don't expect a case study coming out of valuation of intangible. And even if it comes, I think it will be relatively easy because the method is same as we have studied so far the different valuation approaches. So valuation of intangible will be covering or consisting of these three main approaches again: the market, income, and the cost approach. So three approaches are used for valuation of intangible. But the most commonly used is the DCF, income approach. So exam, if the question comes in, which are the methods which are used, the answer would be all the three methods. And if the question comes, which is the most commonly used method, the answer would be income approach, friends. So what under income approach? That is important. So that is another exam question. What under income approach? So next slide, very important from exam point of view. Exam question. Exam question. So there are 5 types of method under the income approach. 5 types of method under the income approach. Very important. 5 types of method under the income approach. And the 5 methods are MWM model, multi-period excess earning model. Multi-period excess earning model used for valuation of primary intangible asset. Primary intangible asset. Then we have the RFR, relief from royalty. Relief from royalty. RFR is nothing but relief from royalty, used for valuation of brands, know-how. These are all exam questions. Brands, know-how. Then WWM method, with or without model. With or without model, used for valuation of non-compete agreement. Used for valuation of non-compete agreement. With or without model. These are the 3 major ones. And then the last 2 are very not so common. So greenfield and distributor method. Just remember this one exam question. Greenfield method and distributor method. Greenfield method used for valuation of franchisee agreement, and distributor method used for valuation of secondary intangible asset. Secondary intangible asset. So these are the 5 types of income approach used for valuation of intangible asset. Remember this slide, very important. You are getting 1 mark because of this particular slide. So let's start from the first method, relief from royalty. Now, I will ask you certain questions. You can answer it so that the method becomes very clear. This concept is used whenever we want to value the brand. Okay, now when we want to value the brand, why do we need to value the brand? First reason is because maybe we are purchasing that brand. Now, when we are purchasing that brand, we need to value the brand. And we create a hypothetical situation that if we are not purchasing the brand, but if we are using that brand, we would have to pay a royalty. Yes? When we are using a brand, we have to pay royalty. But when we purchase a brand, can you tell me, do we need to pay a royalty? Do we need to pay a royalty? No. So, can you now tell me if avoidance of outflow is considered as what? Avoidance of outflow is considered as what? So if you are not paying anything, that is your income or your cash flow. All your cash flow. Yes, it is your cash inflow. So under RFR, relief from royalty, you are getting a relief for not paying the royalty because you are purchasing that brand. That is why the name relief from royalty. So when you are saving something, and if on saving, if I have to pay certain expenses or tax, I will deduct that savings, that expenses or tax, and I will consider the net cash inflow, and by calculating the present value of that net cash inflow, that will be my value of brand. Present value of net cash inflow from non-payment of royalty is the value of brand. Very simple. We just have to consider the royalty saving. Right? Now, how will you consider the royalty calculation part? The question would be that how do you calculate the royalty amount? Then the royalty amount could be calculated based on market information, databases, or let's say any information from statutory authorities. From that, we can find out what is the royalty rate, and then we can calculate the royalty saving. So very simple approach, RFR, relief from royalty payment. Let us solve one question on this so that it is very easy for all of us to understand. This is the question. I would again request everyone to take a screenshot, and so that I will solve it on Excel and you are able to grasp it. I would again request you to open up your Excel and solve it along with me. So should I open up the Excel? Okay, so let me start with the calculation part. So can you give me the year 1, 2, 3, 4, 5? Royalty, expense, tax. Sorry, not royalty. Sales, royalty, tax. So what is the royalty rate? Anybody? 2%? Growth rate for each year sales is how much? 5%? And sales in the first year is how much? 1 crore? Right? Any mistake in data? Can you just confirm? The sales are increasing at the rate of 5%. Am I correct? Royalty rate, now we understand it is 2%. Tax rate is how much? 25%. And what is the discount rate? Anybody? Discount rate is how much? 15%. Okay. So we just calculate the NPV. Present value is equal to right, friends? This is the value of brand. Value of brand. Any doubts? Any question on this? So let me move ahead and go back to the presentation part. So I hope the concept is clear. If you are solving it along with me, it will be very good. That will make things more easier for you because the exam time is coming very near, friends. Let me tell you, exam time is coming near. You need to start practicing about it. Okay, so the next model is known as the incremental cash flow method, or with or without method. With or without method. Right? So that is known as incremental cash flow method. With or without scenario. Now, what do we value under this method? So your answer would be non-compete agreement. Non-compete agreement. Next question, what is a non-compete agreement? A non-compete agreement is entered between the company and the employees, between the new strategic investor and the employees. Then it may be between a vendor and the company, where the vendor would be restricted from entering into a agreement with some other party. So now there are so many types of non-compete agreement. Now, why do we need to value this non-compete agreement? The logic is very clear. When you enter into a non-compete agreement, friends, what can happen is that can you tell me, when the company has entered into a non-compete agreement with its employees, that if they ever leave the company, they will not start the business? So what is the impact on the sales? Whether the sales will increase or decrease?
Increase.
Increase. So with the non-compete agreement, the sales would be higher. And when the non-compete agreement is not there, the sales would be lower. So if you want to value the non-compete agreement, we have to consider the cash flows. And the cash flows will be nothing but the incremental difference between the sales with the non-compete agreement and the sales without the non-compete agreement. And that is regarded as the incremental cash flow. So very simple concept. Whenever we want to value such kind of intangible asset like non-compete agreement, we will try to estimate two cash flows, two income. One, when the agreement is there. Second, when the agreement is not there. And considering the incremental part, after adjustment of tax, we will calculate the present value and get the value of that non-compete agreement. Very simple again, nothing complicated about it. Any questions on this? No? The third, multi-period excess earning method, multi-period excess earning model used for valuation of primary intangible assets. Now, you would say, what is a primary intangible asset, friends? The primary intangible asset is that intangible asset which is the main drivers of the firm value, and the cash flows associated with that particular primary intangible asset could be isolated. Two important words from exam point of view, where we can differentiate the cash flows which is arising because of that primary intangible asset. Then this method could be used because that particular primary intangible asset might be giving some extra earnings. That is the extra earnings which is being used to calculate the value of that particular intangible asset. Now, example could be for so many companies, there is one brand which is working, which is the main driver for the company's value creation. So maybe for the company Apple is the main primary intangible asset. For the company McDonald's, it could be the McDonald's primary intangible asset. So there are so many companies, which is basically the consumer product companies, where the primary asset is the main driver of the business. So when it happens, then we can use this multi-period excess earning model. So two things, primary intangible asset and isolation, two exam questions. The third type of exam question which will come in relation to this multi-period excess earning model is that from that particular cash flow arising out of the primary intangible asset, we have to deduct expenses which are being incurred on certain assets which are known as contributory assets. Contributory assets, those contributory assets are assets which are necessary to support the earnings associated with that primary intangible asset. For example, a very simple example could be, along with that primary intangible asset, we might be using certain other intangible assets or certain assets to generate the earning of the primary intangible asset. For example, working capital. Now, working capital is used in general for the overall business. So there might be certain portion of working capital which might be used by that primary intangible asset. So we have to consider the cost on that particular intangible asset or the asset which is being used by the primary intangible asset. So those assets are known as contributory assets. Basically, it is nothing but an opportunity cost which has to be considered on all these type of assets which are supporting the earnings of the primary intangible asset. And the difference is known as excess earnings. The difference between the earnings out of that primary intangible asset and the expenses which are incurred on that contributory asset, that difference is known as multi-period excess earning model. So third word, contributory asset, and the expenses on that contributory asset will be known as contributory asset charge. Remember, friends, 4 words which we have to consider. 4 words. First, isolated cash flows. Second, primary intangible asset. Third, contributory asset charge. Fourth, contributory asset and contributory asset charge. These are the 4 things which you have to remember under multi-period excess earning model. When it is used, 5th question, valuation of brands, technology. These are certain examples where we use multi-period excess earning model, primarily used for the technological assets. Let us solve some one question on this method. Yes. Here the question is coming on the screen. Just a second. So till now we have studied all the three models, three main models. First is RFR, WWM, and MPEEM model. The most widely used, it all depends upon the type of intangible. So I would not say that out of the three, this model is used widely. So it all depends upon the type of intangible which you are trying to.
The presentation is not visible.
Yeah, I know. I know.
Okay.
So the whole method is, all the three methods are simple. I'm just trying to connect to the presentation. Just 1 second. And as I said in my previous class, friends, the crux of passing the exam is solving as many practical questions as possible. As many practical questions as possible. So please solve questions from whatever sources you can gather. So here's the question on the screen. Yeah, so the question goes like this. We have to calculate the goodwill as per multi-period excess earning model, where we have the net identifiable asset as 5 lakh. Now, what is this net identifiable asset? This is the contributory asset, which is contributing to the primary intangible asset. The normal return, that is the expense percentage on all these identifiable assets, is 15%. Earning for the last 5 years arising out of that particular intangible asset is given last 5 years. It is not for the future, remember. And the discounted rate is 20%. So can we calculate the goodwill as per this particular model? Anybody who can give it a try and answer it? I'll give you 2 minutes to solve the question.
Hello.
Yes.
Sir, you have given the earnings for the last 5 years.
Correct.
So even the discounting rate will be applicable on this one?
No.
That's it.
Yes, anybody with the answer? One crore. Suhani has given me the answer as 1 crore. Anybody else want to give it a try? No. So let me tell you, friends, in exams, questions will be altogether new. And it is not like that whatever you have studied, only those questions are going to come. So be prepared. And that is why I requested that we should give it a try. Even if it is wrong, not a problem, but at least try to answer the question, whatever we have understood so far. So that now conceptually we are getting, until you don't solve it, you will not get the approach. As I normally say, because there might be few people who may not be understanding Hindi, but I do share a lot of couplets in my lecture. But when it is a broad-based participant coming from South and East, then I don't use those couplets. But anyway, because as I said that you have to solve it, then only you'll be able to understand it. And somebody has said it in Hindi. मोहब्बत को समझने के लिए एक बार टूटना जरूरी होता है दोस्तों. So same way, to understand a concept, you need to solve that concept. Yeah, Shushanto Chaudhary ji, 265, Subramaniam Swara ji, 255. Okay. Here's the solution. Average earning, that is the past. That is the earning made by that intangible asset based on the past. So 1,28,000. Now, what is that CSE charges? The contributory asset charge, that is 5 lakh into 15%. 5 lakh into 15%. Presentation gone. So 5 lakh into 15% is 75,000. So my excess earning is 53,000. My excess earning is 53,000. Correct, Mr. Sudipta? My excess earning is 53,000. And out of that 53,000, this excess earning is going to be accrued till how many years? Till how many years? 5? 5 is past. 5 is past. Till how many years are we going to have this excess earning? Anybody? Is the life of the asset mentioned, Mr. Subramanian Swara? Mr. Shushantu, where is it mentioned 5? No. Infinity. Yes, Mr. Rohit, you are correct. Till infinity. And if we want to calculate the present value of cash flow till infinity, what do we need to apply? Gordon model. Correct. That is why today in my lecture, in the first question was based on this Gordon model. And a lot of you answered it. But then how to apply it, that is important. Understanding and then applying is altogether different thing. So when 53,000 is going to be earned till infinity, applying Gordon model without any growth rate. So 53,000 divided by the discounting rate, 20%. And we get the answer as 2,65,000. So this is how do we calculate this multi-predictive learning model, right?
So we will not consider normal return as G. It means like in Gordon model, if there is infinity, what we do is we subtract in the denominator discounted rate by G. So this normal
There's no
return.
growth rate here. There's no
Okay.
growth rate, so growth rate 0.
Okay. Okay.
Yeah. So we have done 3 models: MP, EEM model, WWM model, and RFR. Okay. Few questions again, theoretical part on the screen.
So Khandelwal,
Yes, correct answer is 1. Correct. Second question. The correct answer is second. Correct answer is second, not fourth. Correct answer is second. As I mentioned, that royalty rate will be determined from market information, not the royalty value. Correct. Contributory asset charge. Right. So if you are aware of the term, if you are aware of the the terminology, I think then it is easy to answer the question. Now coming to the last 2 methods, distributor method and the greenfield method. So distributor method, just need to remember, friends, it is used for valuation of customer related intangible asset. Customer related intangible asset, because this is the secondary intangible asset. See, primarily the intangible asset could be the brand. Primarily the intangible asset could be the brand. But how does the brand reaches the customer? That is also important. So there is a customer relationship. That is why that product is being sold. There is a customer loyalty. And that particular product reaches to the customer through some distributors, through the channel of, the wholesaler, retail, distributor, and the retailer. So that is why the relationship with the customer loyalty has to be measured along with the primary intangible asset. So that secondary intangible asset is the customer, and we can use the distributor method for the same. And the last is the greenfield method, where it is used for valuing the franchisee agreement and the broadcast spectrum. That is all we need to remember in terms of exam, because no technical question will be further asked on this particular topic. So 5 methods, friends, and the respective areas where it will be used for valuation of intangible. Apart from that, friends, one important part which has to be considered is on the life of intangible asset, because we have to consider the cash flows for a particular time period. Now, when we have to consider the cash flows for a particular time period, till what time period? That is a question mark. So for that, we need to estimate the life of that intangible asset. And how is this life calculated? Again, that life is based on so many factors, which may include like the historical pattern, which may include any legal regulations, judicial pronouncements. It may include the renewal pattern, the competitive forces, the level of capital investment, the rate of technological change. So there are so many factors to be considered to estimate the life of the brand. So let me tell you, friends, valuation of intangible though looks very simple, but requires a lot of market research, data, and information. Then only we'll be able to estimate the cash flows, the life, the useful life, because it is very essential to estimate the life also. There might be a certain branch which you may think that may go on till perennial, that is till perpetuity. It may be a possibility. So it is all up to the valuer's assumption and the company's management perception. And then accordingly, we can try to estimate the life and do the valuation part. One important factor again, which is not being considered in our calculation, is the tax amortization benefit. So
Excuse me, sir.
yes, sir.
Can you describe 3 examples where will be the market sources for getting the information of intangible assets?
3 example, I did not get.
Actually, I am asking if there is intangible, so what will be the market sources we can get the information
No,
for
market
different
source. If I want to say,
for a
let's say,
particular.
yeah. For giving you the example that if you are using the Domino's brand, then what is the royalty payment? So what could be the market forces? The equal amount which somebody is paying on the McDonald's brand or on the KFC brand, that is the market sources. So on that basis, I can estimate the royalty payment of Domino's. So market sources is whatever is available on the market front, that whatever information you can gather from the world of Google or through, let's say, legal databases, that is MCA, or any other official government website. So that is the market sources. Yes. So the last part is the tax amortization benefit. In our calculation, we all understand whenever a asset is subject to amortization, depreciation, impairment, because all these 3 things are non-cash items, but there is always a tax benefit when we amortize, impair, or depreciate a particular asset. So we have to consider the tax benefit because of that amortization also, because that may also accrue along with the valuation part. So one is purely the income, which is accruing because of the intangible, and the other is the tax benefit, which is accruing along with the income because of the amortization factor. So we have to consider both the part in estimating the future cash flows. So that tax amortization benefit in our calculation, I have not considered it, but you can always consider the tax amortization benefit. So this completes our topic on valuation of intangibles. Let me throw some questions for you on the screen, and then we'll start with the next topic. So people are answering C and D and A. So a lot of confusion. D is the correct answer. Yes, I think A, C is the correct answer. The next question. Next one. Simple ones. Right. Simple one again. Next one. Right. Next one. A. How come A? Most suitable.
A or B, sir? B, no?
The correct answer is E for A.
Okay.
C, D, C, C, C. Okay. The next one. B. Okay, yes, B is the correct answer. Good. Good going, team. I think you are getting it correct to the most possible extent. The correct answer is D. Yes, all of the above. Yes, D is the correct answer. Right. So 16, 16, 16 is the correct answer. Good. Good, 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 everyone. Right, friends. So we take a small 5-minute break before we start with our next topic of valuation under specific situation. Right.
Sure, sir.
Yeah, should we start, friends? So the next concept is valuation under specific situation, where we will consider how to do valuation under specific situations such as distress asset, such as startup entities, such as small and medium enterprises, such as cyclical firms, investment entities, and insurance coverage. So again, the coverage is vast, where we have to understand each and every specific situation and the changes required in the respective methods which we have studied so far for valuation. And I believe if you understand all these specific situations, you will come to know that we have so many areas of valuation, so many opportunities for valuation. Friends. It's not only about the approaches, but you see the different variety of areas and the type of work which can generate. I think we have immense possibility as an opportunity for the valuation professionals. So let me start with the first part, distressed asset valuation. Now we all understand what is a distressed asset. A company which is under stress and a company which is not able to generate cash flows, proper cash flows, and not able to repay the debts. And the reasons why the company goes under stress is multifold. It may be operational, financial, legal, and other factors, where operational relates to the operation part, the product issue, the quality issue, the manufacturing, the plant issue, and so many other things. Financial, I think one of the major reasons of companies going under stress when the company is over leveraged and high cost of funds and the fund mismanagement, and then it leads to the stress part. Then there are instances of legal and regulatory issues where non-compliance of law makes the company going under stress. And the other factors could be the not so good cordial relationship between the management and the labor, the workmen, the people, and then the company goes under stress. So the reasons are so many. Yes, we don't need to go into details of why those reasons happen, but the consequences of a stress could be the product quality, loss of key staff, losing customers, management indecisiveness, litigations, and over leveraging. So reasons and the consequences. I think this is a very common thing which does not need much deliberation. Now, why do we understand? Obviously, because when we do the valuation part, we should know the cause of stress, the reasons of stress, and the effects on the company regarding the after the stress is happening. So that is why it is important to go back and understand the important things. Now, coming specifically on to the valuation, that what is the impact on valuation? Now, when we talk of stress asset, let me tell you, friends, when we talk of stress asset, normally the concept comes in the company is under insolvency in the current scenario because of the IBC Act. But when I consider the word stress, I would segregate the companies into two angles. The first angle is that the company may be under stress, but it is not under insolvency because the company is running. Able to sell the products, generate cash flows, but not enough cash flows. Maybe the sales are declining, maybe the profits are declining, and not positive cash flows, not able to repay certain kind of loans. So that is one angle of the stress asset. And the other angle which we will consider is the company which is gone under IBC. So these are the two aspects which we are going to consider for the stress asset valuation. and looking to the current scenario, friends, current scenario, and what is being read in the newspapers and the business magazines and the channels, it is being forecasted that in the next 2 years, next 1 year is very crucial for all the corporate world in the Indian market, obviously a lot in the whole world, that a lot of companies are feeling the stress, and that is just because the moratorium is there with regard to banking, so that pressure is being eased out. But once the moratorium is lifted, and you will see a lot of obligations coming on the corporate world for repayment of loan, then the
Sir,
stress
my
will be.
question, sir, one question I have coming to my mind. Hello.
Yes, yes, please ask.
Actually, क्या है कि there are so many company work working in the industry. If there, so you suppose you did the valuation just one
Yeah,
month or 2 months before,
hmm,
and there is some knowledge comes that there is a investigation rate on that company, or there is some kind of they are not doing the business or sales is bogus sales like that.
right.
So there is any problem in a valuation part, valuation professionals and valuation. If there
See,
is something about
this,
these things.
this a very practical scenario raised by you, Mr. Anil. Under that situation, see, first is when you are doing the valuation, you are doing a valuation on a particular date. Now, that valuation is obviously based on the information which is provided by the management. Now, whether that information is wrong, bogus, that obviously we take it from the management regarding the management representation, that whatever they are trying to say is true, correct, legally correct, and everything. So that gives you a certain kind of cushion that I have relied upon the management representation. But to what extent that is correct, I cannot go and check. I'm not done any due diligence of the correctness of that particular information. Now, whether that information is justified or not, that we can obviously do from certain kind of market research, past data, and so on. So first thing is you take a lot of management representation regarding the correctness of the information. Second thing is you are doing a valuation on a particular date, and that particular instance, what you are mentioning, does not existed on that particular date, and even on the signing of the valuation report. So these are events which are consequent post you are giving the valuation report, and that is why I think that will not be subject to any problem, because once you have created a documentation part from your angle, probably you will be you will have that enough safety cushion to safeguard yourself.
Thanks.
So consequently, if you want to put a disclaimer on your report once you have given it, you can obviously send a mail to the company that my report now does not holds good because of these events. I don't know what would be the legal status of that particular situation or report, or you're sending that mail. But on the safer side, you can always say that my report does not now hold good because these are the events which have come up and which were not known at the certain date of valuation. So maybe my valuation would not hold good.
Because there are so many information coming in the newspapers that some company have this problem, that problem. So that's kind of things is going on.
Correct. I'm totally with you, and that's a very practical scenario, especially in the Indian cost context, and that happens in a lot of cases. But that is why the documentation is very essential as a part of the whole valuation assignment. Okay, so first let us understand, friends, the features of declining company, which are very specific, those stress asset, and we need to understand the features so that we understand the impact on the valuation. Then. Now, first two features are very common. I think we all understand. I will concentrate on the third feature, which is very typical for the declining company, and just trying to recall the formula for valuation of business for any company. The formula stands as this. I think everybody is able to recall that. So the value of business is present value of free cash flow for the growth period plus present value of the terminal value. Present value is based on the calculation of KO. KO is based on the calculation of weights, that is W1 into KE, W2 into KD into 1 minus T. The weights are based on market value, right? Very important, weights are based on market value. And then we have the terminal value formula for free cash flow for the last year, and then applying the growth rate and applying the Gordon's model. And the formula for EBIT, free cash flow calculation, that is EBIT into 1 minus T minus increase in capex and minus increase in working capital. Any confusion on this formula? I think this is very clear. Now I'll try to correlate the stress asset part with this formula so that now it will be very clear that what changes we have to make in the calculation part to do the valuation of a stress asset. Now, the first formula is EBIT into 1 minus T minus increase in capex. So normally for a stress asset, do you think there will be any increase in capital expenditure? Do you see any possibility of increase in capital expenditure? No. That means this formula will undergo a bit change where, though the formula will remain same, the answer could be the increase in capital expenditure could be 0, or there could be a possibility of asset divestiture. Now, what is asset divestiture? It is simply meaning sale of asset. So rather than an increase in asset, we can always consider a sale of asset. That is one of the important features of declining company, friends, that instead of increase in capital expenditure, there will be decrease in capital expenditure. There will be decrease in capital expenditure. Then the fourth feature, which could is again one of the important features of declining company, is big dividend payouts. Now, you would argue that, sir, if the company is under stress and you are expecting a big dividend payout, normally, you see, companies under stress, that does not mean that the company has been stressed since beginning. So the hypothetical situation is that the company was running good for last 5, 10, 15 years. So it has built up quite a big amount of reserves. And today the company may be under stress. So what do they do with all those reserves? They may pay out big dividends, go for a stock buyback. Why? Obviously, because the company could be trying to maintain the stock prices just to ensure the stock prices don't go down. That is why the company is paying big dividend and stock buyback, going for stock buyback. So that is again very important feature of the declining companies. And the last is, we all understand financial leverage. What does financial leverage means? And you don't expect a declining company to raise more funds through loan. So in that case, there will be the financial leverage will go down. That is natural to happen. And the company will not be able to raise more funds through the loan option. So these are the features of declining company. Remember the third and the fourth part. Now, once you understand the features, now let us understand the impact on the valuation part. How the valuation formula would be impacted in terms of calculation. So we all know that the cash flows are distributed into two parts, the growth period and the stable period. Yes, the growth period and the stable period. The growth period normally ranges till how many years? Growth period normally ranges 5.
2 to 5.
Yeah, 5. 5 is normal. Yes, it may. Can it go beyond 5, 6, 7? And if yes, under what circumstances? If there's a long-term contract, Mr. Nathan, yes, perfect. Yeah, when there is a predictable cash flow, Mr. Rohit, correct? We can, when you can predict it for a further extended period of time, fine. Yes. So in case of long-term contract, predictable cash flows in terms of infrastructure project, then the cash flows have to be forecasted for an extended period of time. So there are scenarios where the growth period could extend. So one, there is a growth period and the stable period. The stable period will go on till what period, friends? Stable period will go on till what period? Perpetually. Correct, Mr. Satish Chandra, perpetually. Good. So we have the growth period, we have the stable period, we have the KO and the terminal value. So when it comes to the valuation issues, first is the, the growth period cash flows are estimated based on what? The growth period cash flows are estimated based on what?
Growth assumptions.
Yes, one is growth assumptions. Second,
Prediction of order.
yes, and more. So all these are based on what? What is the base?
Cash flow.
Correct. But the cash flows are based on what? I mean, what is the possible base? If I'm estimating that, say, in the next 1 year, the sales would be 10 crore. Now, how do I estimate that 10 crore? What is the criteria?
Based on my customer projection, based on the order I do have into my kitty.
So that order, kitty, or projections, these are having certain kind of background or not?
Correct.
Capex.
Capex is future, but what I mean to say that if I'm forecasting, that forecasting has to be based on certain past. So that means the company does have some existing asset, and because of that existing asset, the company will be able to forecast the future cash flows. So in terms of asset, we segregate the company's asset into two parts, the existing asset and the growth asset. Now, what could happen in case of a stress asset? The existing asset may not be earning that much or maybe earning less than the cost of capital. That is why we sell those existing assets. That is a sale of asset. So we defined in the formula the sale of asset. Second, you will not find any investment in the growth asset because the company does not have funds. So existing asset will be sold, no investment in the growth assets. The third, the discount rate will change. Why it will change? Because first thing is that the capital structure ratio of the company may change. Why it will change? Because we know that the cost of capital is based on cost of debt, the value of equity, value of debt, and so on. The cost would, the capital structure would change. Why? The reason is, first, can you tell me if a company is under stress, if I have an outstanding loan of 50 crore, you expect me to pay 50 crore?
No.
No. So that means if I have to take the value of 50 crores, will that be 50 crore or less than 50 crore?
I'm able to pay less than 50 crore.
Yes. So that means when we have to calculate the weights, in calculation of weights, I will not consider 50 crores, I'll consider less than 50 crores. So that will change my capital structure accordingly, that will change my weights, and that will change my KO. So therefore, the discount rate would not be the normal discount rate which we calculate for a normal company, but it will be something different. Then there could be a possibility because of large dividend and buyback, the capital structure ratio may change. So accordingly, the KO may change. Then it may be a possibility that the loans could be converted into equity because the lenders might convert their loan into equity because of certain conditions. So then again, the capital structure may change. So because of the stress effect, there are possible impact on the overall capital structure, friends. And because of that possible impact, the normal calculation cannot be done, and we have to take into consideration the additional factors for the calculation part. So this is the impact on the KO, friends. Then the impact is felt on the terminal value. Terminal value, which we all understand, is calculated when? Can anybody tell me when is the terminal value calculated? When is the terminal value calculated?
When the life of share is for perpetuity.
So in terms of, let's say, if the growth period is 5 years, when is the terminal value calculated?
End of fifth year.
End of fifth year. Yes, so end of fifth year and beginning of stable period. End of fifth year and beginning of stable period. Very important. Remember this. End of fifth year and beginning of stable period. Anyway, so now terminal value, if I want to estimate the terminal value after 5 years, there's a tough job in case of a stress company because we don't know whether the company is going to survive till that particular stage. And whether the growth rate will be positive or negative, that is always a question mark. So these are the issues which will come in when we value the stress asset. And after considering all these factors, we need to make the changes and then calculate the value of the stress asset using the DCF model. The model remains same, the DCF. The only thing is the calculation part would change because of the impact on the various parameters which are used for calculation of the stress assets. So this is one angle of the stress asset calculation. The other angle for calculation of the stress asset could be the valuation of companies under IBC, because we have all gone through the topic of IBC in your curriculum within this 50 hours training program. So I'll not go into details of this IBC code, but just focus on the valuation part and the issues faced during the valuation. Now, as I believe, as a registered valuer, you would definitely get an opportunity to do valuation of cases under IBC, because this is the one area where by law it is a compulsion that valuation has to be done by a registered valuer. And in last 1.5 years, I've done more than 40 assignments of valuation under IBC, and I'm sure that each registered valuer will definitely get an opportunity. That is why I will focus on certain practical issues also. Maybe that not much relevant to the exam part, but a healthy discussion is always warranted for, because it is going to be a very burning issue when you start practicing in the world of valuation. So one exam question. As per rule, we have to measure fair value and liquidation value. So as a registered valuer, we have to give two values, the fair value and the liquidation value. And on which date, friends, remember, we have to give the fair value and liquidation value as on date of insolvency commencement date. Insolvency commencement date, remember. Exam question, we have to do the valuation on the insolvency commencement date, ICD. Remember, fair value, liquidation value. And the RP has to appoint two registered valuers, right? Very clear. Now, they have to follow, apply the internationally accepted valuation standard after physical verification of the inventory and the fixed assets of the corporate debtor. And
Mr. Khandelwal, sorry to interrupt you. This
Yeah.
liquidation value is to also be worked out on the insolvency commencement date or liquidation commencement date?
insolvency commencement date.
Both are on the same date, insolvency
Correct,
commencement.
correct, yes.
Yes. Right. Then the RP, if the two registered values give a different value where there's a significant difference, then the RP can appoint a third valuer also, and the average of the two closest value will be considered as the final value, friends, of the fair value and the liquidation value. Now, again, in the IBC world, we all know there are two processes. One is the CRP process, which calls for resolution. And if that does not happen, the company may go for liquidation. And during liquidation, the liquidator can also appoint two valuers. So it depends upon the liquidator either to take the old valuation report, or he may go for a new valuation report also. So now this again gives you that there is a lot of opportunities for registered valuers, because the number of cases which are going to come up at least for next 1 year, maybe
Sir,
after 1 year.
Hello.
Yes.
Sir, my question is that if you have both opportunity as a valuer and an insolvency professional for a company, so which you will go for that?
Pardon? I did not get it.
Actually, I am saying you are the IP also and registered valuer also. If
Right.
in the same company you are got the opportunity for the insolvency professional or this registered valuers, so for which position you will go?
No, obviously, sir, the position of registered valuer will come later on, because registered valuer is appointed, subsequent to the commencement of the insolvency process. So the first opportunity which will come to me will be the insolvency part, and that too it will not come on the date of insolvency. It will come time before that, maybe 6 months before that. So a lot of uncertainty would be there. So definitely, given in choice in the sense, because the first opportunity is coming as an insolvency professional, I would take that only.
Actually, I know that, but फिर भी जैसा sometimes it's happened that like that कि I will go to that opportunity like that कि sometimes you got so many the financial creditor is appointing and you have the client, so you also think that he will also select me, then I got the opportunity like that. Okay,
Okay.
no
No,
problem.
but then in that case, obviously, depending upon the type of company, that is always a judgment which we have to take, what is the type of company, and accordingly we can plan. But yes, in terms of, if you want to talk in terms of monetary part, obviously the RP would yield more benefits to you, because the work of RP is spread over a period of more than 6 months, and the insolvency professional is limited to a particular area of insolvency process. So in terms of monetary part, the RP is definitely going to give you much better, not only marginal, but better returns, along with relevant risk also. That is obviously a part of the profession. So given a choice, I would definitely go for the RP part. If you are experienced person as a RP. Otherwise, if you are new to the RP profession, insolvency professional profession, then you can always decide whether you want to jump into this profession or not. So once you have jumped in, then I think we all know the process, the intricacies, the complexities, and the challenges. Then the RP profession will always be better than the liquidation, than the valuation profession. So friends, I was talking about the opportunity in the next 1 year, and maybe after 1 year, there may be a certain dip because of the changes in the law of the IBC. But next 1 year, if we expect around 1,500 companies to come under insolvency, which is definitely going to happen, around 1,500 companies would be lining up for the insolvency part, along with liquidation, so clubbing both together. So that will give you an opportunity of 3,000 valuation reports required in the next 1 year. That is enough work to be generated, new work, apart from existing work which you have been doing, which you will be doing. So this will be new work which will be generated. So that is why, as a IBC is one of the important acts to be followed by all the registered valuers, and be connected with the profession of insolvency and the insolvency professionals. Okay, so as per the law, we need to determine the fair value and the liquidation value, and the fair value has been defined under the Act. That what does fair value means, which means estimated realizable value of the assets. If the company is a going concern, that is the concept under the fair value part. We assume that the company is a going concern, and the buyer would be purchasing the assets on an arm's length transaction. And the liquidation value is the realizable value of the assets again, but it is assumed that the corporate debtor may be liquidated. So that is the assumption. So the difference lies in that the fair value would be basically broad based on the concept of their company is a going concern, and liquidation value will be assumed that the company would be liquidated. So these are the two major differences. Now, how to differentiate the value? That is the difficult job. As a valuer, that is always a difficult call which we have to make, that for a particular asset, how do we differentiate between the fair value and the liquidation value? Let's say, for example, the securities and financial asset valuer has to give a value to the debtors. So the company shows a debtor of around 50 lakhs. Now, what is the fair value and the liquidation value of that 50 lakhs as on the insolvency commencement date? Anybody who can give me a differentiation? How can we do that?
So one is to verify what are the actual receivables. You do a aging analysis and also a verification of which of those debtors will actually materialize, during the CARP period.
Right, Mr. Rohit, we do analyze, agreed. But my question is, after analysis, I've analyzed everything. Now, how do I differentiate between the fair value and the liquidation value of the assets of the same debtor? After analyzing everything, I've got the records. Now, what is the possible difference between a fair value and liquidation value of the debtors? So how do we differentiate that 50 lakhs is the fair value and 45 lakhs is the liquidation value, or is it both the same?
So they can be the same again if the valuer is gone after the analysis.
Your voice is not audible.
Sorry. So they can be the same if the valuer is confident that the amount will be receivable. For example, even under a CARP, it could be an operating company, and if we are certain that the funds will be received over a period of time, then the value could be same. Otherwise, it is up to the valuer to determine, if there is going to be a scenario where.
Yeah. So
Hello.
as you
It may be
correctly
different.
said,
Hello. Hello, sir.
that
Hello. Hello.
so as you correctly said, am I audible now?
Now it is okay.
So as you correctly said, that it is up to the valuer now to decide that what will be the possible difference between the fair value and the liquidation value of the same amount of debtors. So
But
fair value, we will assume that it will be 50 lakhs on the assumption that the company is an operating company and it will be going and will be realized. But when it comes to estimating on the liquidation value, it becomes a tough job of estimating a liquidation value, which we always know that it will be either equal or lower. That is for clear. But how much lower? If it has to be lower, that is a difficult call to be estimated, even after analyzing the debtors. So today, the biggest challenge for the registered valuer is to estimate the liquidation value in certain cases. See, if it is a fixed asset, we all understand that there could be a scientific way of calculating this liquidation value. But when it comes to current assets like the debtors, the loans and advances, then it is always difficult to estimate the calculation of the liquidation value.
Sir, will you elaborate the fair value valuation and this liquidation value? The liquidation value is based on the cost approach. What is the land buildings cost we have? So sometimes it may be like that the fair value may be less and liquidation value will be more. Because company have the more assets value, the land building and plant and machinery like that.
No, it could not be possible that the liquidation value could be more than the fair value, because under fair value also we can consider the fair value of the land and building. If it is possible, that can be done. So I don't think so there is a possibility. It could be a very extreme. I'm not able to imagine that kind of situation where the liquidation value could be more than the fair value, but quite tough. Fair value has to be higher.
But sir, in liquidation, we always consider the realizable value, no? So fair value, it may be higher or lower than the fair value.
No. I think there is a confusion on understanding part of fair value and liquidation value. When we estimate the fair value value of the business is again based on the valuation, the realizable value of the assets only. There is
That's correct. That is might be the baseline. But when we are entering into the
There is
liquidation process, we always consider how much it can face if we sell in the market at the time of liquidation. No, so that is
so
the
same is
basic.
considered in the fair value, sir.
Fair value generally it is at arm's length if it is between two unrelated
Yeah,
parties.
so it is always yeah, so it is always more than the liquidation value.
Yeah, that's what is my also presumption.
And second
Right. So
question is
fair
that,
value.
sir. Hello.
Yeah, please. Please ask.
In both, yes, in both the fair value valuation and liquidation valuation, so you are considering both the value layer of asset class and land and building for your calculation, fair value and liquidation value both RP of
No,
financial.
no. I am purely considering as an general valuation aspect, considering the overall assets of the company. We'll always assume that the fair value will be higher than the liquidation value. If the liquidation value is higher than the fair value, then in that case, it is always better to stop that company. But the whole concept of a company is a going concern. And why we need to make that company as a going concern is because running the company is always better than the selling the closing
Sir,
the company.
actually, I think you don't got my point. I am asking only the discussing with the IBC.
Yeah,
If you
IBC only.
suppose Gaurav, if there is three or six RP value is wanted. If you are kind of a security or financial value layer, so you will also
Yes.
consider the both of the report of the land and building and plant and machinery value layers also for your liquidation
No,
value
I won't.
calculation.
No, I won't.
So,
My
feel
job
what
is
we
only to consider the securities and financial assets.
okay, so based on that valuation, you will do the kind of a company valuation.
No, as a RP, I would do the valuation as a whole, including the land and building, the plant and machinery, and securities and financial assets. So I think there is some gap in what you are trying to say and what I am trying to answer.
Yeah, मेरा question देखिए, if the security and financial doing the all the company valuation,
No,
my
securities and
question is
financial
right.
asset can only do the securities and financial asset valuation.
Okay.
They cannot do the land and building valuation and the plant and machine valuation.
No, they can do. But I am asking for the valuation of the company.
Yeah, that's what I'm saying, sir. If a valuation of a company has to be done, the securities and financial asset valuer will only do the valuation of the securities and financial assets.
Okay.
He
So then,
cannot do the valuation of land and building and plant and machinery. Is it
okay,
clear?
okay.
So, friends, as a valuer, as a registered valuer for IBC, there are a lot of challenges. And as in the last class, I think somebody mentioned that one of the participant is a RP. So he might be knowing the challenges faced by for the valuation of cases under IBC. The challenges are obviously many, including the uncertainty and the absence of reliable data, because we don't get much of information, because we are dependent upon the RP to get the information, and RP in terms is dependent upon the management, the suspended management to give the information. So in so many cases, we have found that the company is not running. The company has been closed for last 3, 4, 5 years. The balance sheet is not available. The details of debtors, loans, advances are not available. So a lot of issues come in terms of valuation, and in lot many cases, I've seen the valuation report is submitted as the value of the company as zero, because you don't have any information. And then we don't have the comparable parts, strict timelines, if within the IBC code. So these are certain kind of challenges. Along with that, physical verification of inventory is always a tough thing, because as we know that the valuation will be done on the ICD date, and practically what happens, you will be appointed as a valuer after the 50 days of the insolvency commencement date. So let's say, for example, today is the date of order for the insolvency commencement date, and you will be appointed as a valuer after 50 days. So that means you will be doing the valuation, let's say 2 months from now, but the valuation has to be done for today. So there is always a time lag between the date of valuation and when you are going for valuation part. So that will be subject to a lot of calculations, back calculations to arrive at a particular date. So that is another challenge. Then trade receivables, I've already given an example that what could be the possible challenge in the trade receivable part. Along with that, a lot of challenges in the valuation of investment in group companies. And when you have investment in small companies, how do you value those investment in small companies? And normally I take the value as zero because you don't find a market for all those investment done in the private small companies. Even if you have certain kind of fair value, do you think that is realizable? That is always a question mark, whether it could be sold in the market, where there would be any buyer of those shares of those private companies. I doubt it that there could be a possibility. So a lot of challenges, friends. It's not an easy job. In terms of easiness, you see the job could be a matter of 1 day or 2 day also at times, because when you don't have any information, you just have to submit a report saying that you don't have insufficient information. So the value of the company would be zero, or let's say to the extent of only cash and bank balance. But when it comes to a company which is running or even not running, but when you have certain kind of data, then a lot of challenges come in for the valuation part. So these are the issues under valuation under IBC. So let us take one question on the screen. I think that will be relevant enough for all of you. So let me take one question. Yeah. So I would request everyone to take a screenshot again, and we'll try to solve it on Excel. So the question relates to calculation of what, friends? What do we need to calculate?
This cost of capital.
Cost of capital. Cost of capital, right? So let us do the calculation for cost of capital, and we need the formula for cost of capital. Let me open up the Excel sheet. So cost of capital formula we all know. Yes, so we'll calculate all the weights and the K part. Let's try to solve it on Excel, friends. Everybody, I think we can solve it on Excel. Can you give me the market value of equity?
$32.
36.16.
Yes, so it is 32 into 1.13. And what is the market value of debt? 1.5. So let us calculate the weights. Weights of this and weights of this. So we have the weights. So now we have W1 and W2. We calculate KE now. So can anybody give me the KE calculation?
$12.3.
12.3. Anybody else? So RF 6.25 plus RM minus RF 5.5 into 1.1, 12.3, but there is an extra premium. $16.3. Any doubts in the calculation part? You can always raise a question. KD. Can anybody give me a KD figure?
$4.19.
1.99.
4.19.
So the KD would be 6.25 plus 2 basis point a premium. Why this 2 basis point is premium? Because of the stress asset. 6.45. And now we just need to apply the formula with the tax rate given, 35%. 15.82. Yeah, 4.19. Vijay Soniji.
Shouldn't KDB will not deduct tax rate?
Yeah, we have applied the tax rate here in the formula.
Okay.
You have 1 minus J1, 35%.
Okay.
So any confusion? Otherwise, see, the whole concept here is that because of stress asset, there is some extra premium. That is what I said for a stress asset. The formula would remain same. Only thing is calculation of each of the factors might change because of the stress point.
So this KD is that 30-year bond rate, is it?
Yes,
6.25?
you always have to take that, the prevailing rate of interest in the market.
Yeah, they are specifically given the interest paid out. So I was just wondering.
Oh, yes, they are given the interest paid out, but that is based on their book value and historical values. For KO calculation, we always have to consider the market value and the prevailing rate of interest. So that is why I have considered the prevailing rate of interest.
Okay.
Yeah, but the prevailing rate of interest is for the government bond. So that risk factors will be completely different from the company, right?
I have taken the premium point too, sir.
Okay.
And the debt is the amount which is to be settled as against the outstanding.
Which one?
Yeah, book value is 1.918 billion value of outstanding debt, whereas the settlement value is 1.5 billion. That is, you're considering the haircut value basically.
Correct.
Okay.
Because we have to consider all the market values.
Okay.
So let us start with the concept of next topic is on valuation of startups. Yes, I think the buzzwords, the in thing, the happening world, where you will find a lot of things moving around. And yes, why not? Because it is creating a base for the future of Indian business economy. And startups are now one of the growth drivers of the economy. So obviously, when they are the growth drivers, the valuation would be there for all the startup, and you read it in newspapers that how much value is given to all these kind of companies which are recently born, and you always wonder, that how such high valuations are being assigned to such companies. But the fact is, yes, they are valued at high level in spite of incurring losses and with forecasted growth forecasted at normal high rates, with a lot of technological assumptions which may get outdated in times to come. But the reality is that the valuations are done at very high level. So who does the valuation? Obviously, if it is in India, if it is under the law, it has to be done by a registered valuer. So how do they do that valuation? So is there any new rocket science which has been developed for valuation of startup? Is there a new method? So answer is, as per law, we have to follow MIC approach. We don't have a choice. So we have to abide by the law of market income and the cost approach. So through this market income cost approach, the startups are valued, and if they are valued by these approaches, how are they valued at such high price? in spite of being so risky? These are all questions, friends, and let's try to find a solution or answer to these questions. So traits of the yo-yo, hybro, the dude corporations are what? No records, no past records, no revenues, with the fact that you don't know whether they are going to live or not. All investments in such kind of startups are highly illiquid, depending upon private money. These are certain important characteristics of all the startup companies. And when it comes to valuation, what are the factors to be considered in valuation? So friends, what has happened over a period of time? There have been certain models which have been developed for valuing these startups. Apart from the DCF model, yes, DCF model is one of the main models for valuation, but at times we now will come to know going forward, when you will enter the world of valuation and a lot of complications may come in, you will find that whether DCF is actually relevant or not. But today, I think it is mostly the DCF approach which is used. But in highly developed companies like countries like America, we have much more advanced techniques, such as the real option method, which is used for valuation of such kind of companies. So we'll not consider all those technical concepts. We'll just focus on the basic criteria of how valuations are done for a startup. Apart from DCF, there are certain models also which have been developed, which are used for valuation of startup based on financial as well as non-financial criteria also. So the valuation issues for the startup, when we have to consider the DCF valuation, we know that the company does not have an existing asset. So mostly the drivers is the cash flows are because of the growth asset. So we don't have a past record, no history, no trends, and we just need to rely on the forecasting done by the management, right? That this is the future projection. So that is something, sometimes very highly optimistic, and we don't really, we always have a doubt on the forecasted cash flows of such abnormal growth. So we can always give a discount to whatever the management is saying. And as a valuer, we can always give it a second thought and curtail it down. So first is the existing asset is nil. Most of the cash flows are generated because of the growth asset. That is the investment in future. And then the bigger problem is of that the betas are not available. When we have to calculate the cost of equity, you will find that very difficult to estimate the beta, because beta is based on past data and we don't have that much data for calculation of the beta. Then when you see any valuation, then you will see that in a valuation value, in the value which you have arrived at, the component of growth period and component of stable period, if you differentiate between the component part, you will find that the component of the stable period is more than the component of the growth period, which will which means that the component of terminal value is more than the value of the free cash flows of the growth period, which is very obvious. But in case of startup, you'll find that the maximum value is coming out of terminal value. Why? Because in the initial period, we'll assume that the company would be incurring losses or very less revenue. And suddenly, after 3-4 years, the revenue would shoot up normally high, and then they continue with the high growth. So that is again one of the features of the startup companies. So friends, with this background that these are the factors which will affect the valuation world, let us now go through the various methods of valuation. Now, the various methods of valuation, friends, apart from DCF, there are some other methods which have been developed by the startup community, or you can say the valuers community, and based on the research, the information, there are few methods which are purely theoretical and not that much of calculation is involved. So from exam perspective, we have to study. Maybe from practical perspective, we may not follow these methods, and we may stick to only the few methods of market and the income approach. The first three methods of valuation, where the concept is based on a a concept of that a startup is like a box, a very special box, because you have a great idea and you have built that great idea by giving certain inputs to that idea, bringing it to a shape, to a particular level, and that particular box contains that level of that idea which you have in your mind. So when you have put in an effort, obviously the box would have certain kind of value. Maybe that idea is converted into a technology, a product, maybe a very crude product, may not be a finished product, but at least that product has got some value because their effort has gone in. So the methods will assume that this startup is like a box. Now, very logical, friends, if this box has got a value, how do you increase the value? So apart from, generating sales and generating profits, is there any other way can we increase the value of the box without, investing much of in the efforts of building a building or plant or something like that? The answer is yes. If you want to increase the value of the box, the obvious way would be what? To add a patent to your box that will increase your value. Add a good management team along with your founder members, so that will increase the value. Or we can launch a beta version of the product. Then we can launch a soft version of the product, launch of the product. We can test the commercial viability of the product. We can scale up to your city, scale up to the state, scale up to these countries, scale up to the international level. And gradually, over a period of time, the value of the box will keep on increasing. So the idea of valuing the startup or increasing the value of the box is you just keep on adding every time. And the moment you add something to it, the value will definitely increase. And probably it's a very layman's idea. You don't need much of technicalities to understand. And therefore, what do I see? That from the founder's perspective, from the investor's perspective, I think they consider the startup as more of a box of valuation assets, valuable assets, and not necessarily those valuable assets are deriving positive cash flows. But because those assets are valuable, which may in turn in future may increase the value of the box in general. So therefore, the startups are valued at such high price. So 2 words, remember from exam perspective, friends, pre-money and post-money. 2 words, remember. Pre-money and post-money valuation is nothing, but pre-money valuation is the value of the box before the investment is done. Value of the box before the investment is done, and post-money is the value of the box after the investment is done. So pre-money and post-money, 2 words relevant from exam perspective for valuation of startup, friends. So the 9 methods are listed down here. We'll discuss the methods. We'll ignore 2 or 3 methods which are not relevant. So let me start with the first one, the Burkus method. A very simple and convenient rule of thumb rule of estimating the value of box, and certain important things which we have to remember from exam point of view. Through this Burkus method, we can assign a maximum value of $2 million US. Maximum value of $2 million US. Why? Because Burkus says that I can value the box based on only 5 parameters. And to each parameter, I will give a maximum value of 4 lakhs. So if there are 5 parameters and 4 lakhs assigned to each of the parameters, so 4 lakh into 5, that is 2 million. So what are those 5 parameters? The 5 parameters are here on the screen. And when we want to value a particular startup, we can give marks to all these on the basis of all these parameters to the startup. And then when we add all the marks out of 4 lakhs, we get the value of the box. That is as simple as it. So you will see that it's a very simple way of valuing a startup by giving marks based on the judgment of the valuers, based on his experience. And we can arrive at a value where there's no much of consideration on the risk factor, the KE, the discount factors, the future cash flows, and nothing. So I think from the founder's perspective, from the layman's perspective, a very relevant method, because from here we can come to know a ballpark figure of the value of my company. Second, I could work upon the areas where I have to improve upon, where I can score good marks, more marks, and thus increase my value of the startup. So that is Burkus method, friends. Then somebody came up with a more evolved version of Burkus, and he mentioned that not 5 factors, but I'll consider 12 factors. So, and those 12 factors will be considered using the risk factor summation model. So, what he does is he considers those 12 factors, and he assigns value to each of the factor in multiples of 2,50,000. In multiples of 2,50,000, and where the factor, the risk is low, you add, and where the risk is high, you deduct. And the addition and deletion is done in multiples of 2,50,000. So you start with an initial value of the box, 15 lakhs. This question is, how do you arrive at an initial value of the box? From where do we get this initial value of the box? So answer is very simple, that the initial value of the box could be found out from a comparable market method, a market transaction which has been done recently. Let me tell you, friends, these methods are more applied in market where the things are matured enough. Let's say the American market, where things are matured, where we have a lot of data, a lot of information, a lot of startup community is stable. Indian market is still evolving, though yes, the evolvement stage is growing very fast, and you will find a lot of startups, especially in the region of Bangalore, Mumbai, Chennai, Hyderabad, prominently coming up. So if you consider those locations, you will find a lot of information, but that information is not publicly available. So understanding, assuming that the market is stable, you get a lot of information, so we can compare, and we start with an initial value of the bags, 15 lakhs, and then we keep on adding and deducting, and we finally arrive at a box value of 27,50,000. So that is risk factor summation method, friends. The third, again, a more elaborate approach to the box concept, where instead of directly adding or deducting, we assign weights, which is more logical, more scientific, more statistical, that we assign weights on each of the parameters based on the nature of industry, nature of company, and we can assign weights and multiply each of the weights of respective criteria with the performance of the startup with the market. So in our example, let's say we have 4 criteria, weights have been assigned, and the performance measurement has been done for each of the criteria against the average project. Average project is basically the market. And we find that 40%, 125, 30, 100, 20, it is not 15, but 150. Small correction, please. Not 15 plus, but 150. So once you do that, what you can do is 40 into 125. Can somebody do a calculation for me? 40 into 125.
5,000.
50. Then 30 into 100. 30. Then 20 into 150. 20 into 150. Again 30. So 50 plus 30 plus 30, that is equal to 110. And it lasts 10% into 75, 7.5. So 117.5. 117.5. So what do we do with that 117.5? What we do is multiply that 15 lakh into 117.5. 15 lakh into 117.5. That 117.5 is nothing but a multiplier. And so the total value comes to as 17,60,250. 17,60,250. Is it clear? So this is box scorecard, box valuation method, friends. The next we come to a comparable transaction method. Now, what is a comparable transaction method? I think we all know what is a comparable transaction method. That is the market method. And when we consider the market method, I think from a values perspective, friends, I consider this is one of the best, the safest method of all. Why do I say it is one of the safest method of all? Because of the obvious reason that is it me who is doing the valuation? Obviously, I'm doing the valuation, but then the whole idea of doing the valuation is generated not from my angle, but it is generated from the market. So market has created all those concepts, all those logics, and based on that logic, I'm just trying to value the company. So all the technicalities will go to the market. I'm just trying to apply those technicalities to my company. That's it. So that's why I consider that the comparable transaction method is one of the safest methods for the valuer, provided the data which is trying to capture is correct and relevant. So once he is sure of that data, then comparable transaction method could be used. And for startups, I think worldwide, comparable transaction method is one of the most frequently used methods. All the investors do apply this concept of comparable transaction to valuing startup. And let me tell you, friends, when it comes to comparable transaction, it's not only based on what the enterprise value to sales, enterprise value to EBITDA. Here, a lot of non-financial factors also come in for valuation of such kind of startups. Non-financial factors also. So the factors could be number of employees, number of outlets, number of users, number of patent files, number of downloads, number of apps, and it can be so many other factors. Gross merchandise value, GMV, which you must have heard. So a lot of factors have been built in valuation of startups. And going forward, I think the number of criteria would increase, looking to the technicalities involved in valuing of startups of the nature of artificial intelligence, Internet of Things, so much of technicalities coming in. So the criteria could increase and you'll find a lot of technical ways of valuing the startup. So comparable transaction method, one of the most widely used method when it comes from the investment community, not the valuers community. Investment community do compare the investment opportunity by comparing it with some other companies. So the Flipkarts of the world could be based on the Amazons of the world. The Ubers of the world could be based on the Olas of the world. So that is how the valuation is done. Then the book value, I think not followed, not relevant. Why? Because as I said, book value is never a concept to be followed for valuation because it is based on historical. And even for the startups, I think we don't have much of book value. So how do we value a company which does not have any tangible assets? So never followed. Same way, a liquidation value is not to be followed because it again goes against the basic principles of valuing where we assume that the company is a going concern, while liquidation value does not consider a company as a going concern. Then DCF method, as I said, it is the most widely used method. In Indian context, what I've done when I valued a few of the startups, I've used DCF only, and that's the only way out, to follow the valuation standard. Then we have to apply the DCF method. The only biggest issue is the cash flows forecasting, which is tough at times to accept the fact that they are showing such an abnormal growth. Then we have the first Chicago method, which I believe is again one of the very practical approaches to valuation, which going forward should be considered by all the registered valuers, where they say that if you want to value a company, probably you have to value the company based on various type of future scenarios. And normally all the valuations which are done, they are based on only one scenario, that is the best case scenario, which may not be the practical, the outcome every time. So what we have to do, we have to consider all the possible future forecasting, and based on that, we can do the valuation. So this is the see the possible future forecasting scenarios could be the best, normal, and the worst case scenario. And based on that, we can always estimate the value under each of the cases, and then we can multiply each of the case scenarios with the probability of scenario that of
Sir,
that,
your
that scenario.
presentation is not visible.
Okay, just one second. So first, Chicago considers the three possible scenarios of worst case, a normal case, and a best case scenario. And under all these scenarios, we estimate the value of the box, and we multiply with the probability of each of the scenario happening. Now, somebody would say that what is the worst case scenario? Let me tell you, friends, the COVID situation has brought us another fact that a worst case scenario is a possibility where the company might be a going concern or the sales may be zero. And probably after this particular COVID scenario, it is setting a precedent for everyone that yes, we can always think of a worst case scenario with the probability also that because that is always a chance now that any kind of pandemic may come, can come again and disturb the whole world business scenario. So first Chicago method, very practical, considering all the possible ways and then valuing the company. Then the last method is the venture capital method, friends. Again, widely followed by a lot of venture capitalists. So when you see the venture capitalists investing in a company, do they apply the DCF approach? They may apply, no questions on that. But yes, from their point of view, I think as a venture capitalist, we are more concerned with the return part. And therefore, the more focus is put on the return angle. So rather than considering the cash flows and every other thing, they calculate the value of the startup from a different perspective. That is purely on the return part, estimating the return and then trying to find out the pre-money and the post-money valuation. So what is the way out? I think if we understand this particular calculation, things will be more simpler. So the first step, what the venture capitalists will do is if they have identified a company in which they are investing, the first thing they will do is to estimate the future value, the future value of the company. That is the exit value of the company, the future and the exit value. So let's say if they are estimating a company in which they have invested, the future value is about 100 million when they are going to sell that particular investment of theirs. So 100 million is the expected value. Now, how will they arrive at the exit value? It can be based on the comparable transaction method. Let's say if somebody is invested in Dream 11 today, Dream 11 is a company which launches those gaming apps. So what they can do is that today the Dream 11 has around 1 million users. So let's say 5 years is the time horizon which they will think that they're going to sell that their investment. So they expect that after 5 years, the number of users of Dream 11 would be 5 million. So today, if the value of the company is 1 million to 10 rupees per user, 10 million. So after 5 years, they expect that 5 years, 5 million into, let's say 12 rupees, 15 rupees. So that is the value of the company. So based on the comparable transaction method or market method, they will anticipate an exit value. So if that is the value which they are looking at, 100 million, and they determine that today, if I'm investing anywhere, I would require a 20 times return or 20 times increase in the value of my business. So 20 times is the return. So what do they do is nothing but calculate the present value of the future value based on the return. So in our example, if 20 times is the return, so present value would be 5 million. 5 million into 20 times will make the value as 100 million. So that 5 million is nothing but the value of the business as of today after the investment is done. So that means 5 million is the post-money valuation. 5 million is the post-money valuation. $5 million is the post-money valuation. Now, what is the relationship between post-money and pre-money? The relationship is very simple. Post-money is equal to pre-money plus the amount of investment. Post-money is equal to pre-money plus the amount of investment. So, so if post-money is 5 million and the amount of investment is 1 million, so pre-money would be 5 million minus 1 million, that is 4 million. 4 million. So this is how the whole calculation the venture capitalists will do, purely based on what? The return percentage. Purely based on the return percentage. So these are the 9 methods for valuation of startups. Coming to the smaller parts of valuation in a specific situation, and we are entering the last part of our lecture, where now we'll consider valuation of cyclical firms. So what are cyclical firms? I think we all know what are cyclical firms. Cyclical firms are nothing which operate in cycles. That means they will have a very high growth period and very low period, a peak period and a non-peak period. And these are the companies like the commodity side, the commodity companies, the companies which are based on steel or sugar industry. So these are all, cyclical companies. And how do we value such kind of cyclical companies? Because they have, lot of volatility in the earnings part. The characteristics are very clear that they are subject to a lot of commodity price cycle. There are a lot of volatility earnings. The price of the stock issues also lot of price issues in the equity part. Then they are based on the finite resources. Then the healthiest of the firm can be also put to risk if macro move is very negative. So how do you value such companies? Obviously, the method is DCF. And when we apply DCF, what is the things which we have to consider? And the factors which have to be considered is the criteria of the normal year. That is the most important.
Sir, one question.
Yeah.
In your previous slide, you written there that it is a very good company and macro level is not good. So there is some problem in valuation also in previous slide.
Pardon?
In previous slide, there is written that there is a good company and macro level is not good. So
Yes.
in previous slide.
Yes.
So there are so many companies, the macro level is not good, still they are doing well. Even the healthiest firms can be put at risk if macro move is no very negative. Okay.
Yes. This is with respect to the cyclical firms. So
we have to see the macro and micro level also in industries.
Yes, obviously we need to consider the macro changes because macro changes affect the overall business scenario.
Okay, so in future also they can be in distress.
Yes.
Okay.
So the major issue in valuation of such companies is the identification of the normal year, and when we are valuing the company, that point may not be the normal year. That may be a peak period, or there may be a non-peak period also, and therefore we need to identify the normal year. And if that is not possible, we can apply a normalization factor. What is the normalization factor? So we consider the sales of a peak period, and then we normalize it with a normalization factor to bring down the sales with respect to a normal year. So that we can do, either we apply a normal year, or we apply a midpoint of the business cycle, or we apply certain statistical technique like mean, median, mode, average, something like that, to arrive at a normal year cash flows. So the major issue, the one question will come from the exam point of view, is only the base year fixation or the normalization factor, which you have to remember for cyclical firms. Coming to the another important valuation criteria is valuation of SME, small and medium enterprises. Very important, friends, and I think we all as professionals are linked to this word SME, because most of the work is generated from the SME segment as a professional. And going forward also, I think a lot of opportunities are going to come from the SME segment. And we all know that they are major component in the GDP part. In times to come, because of the initiations and the steps taken by the government also, we believe that it is going to play a very important role. And with the promotion of all the Atmanirbharta concept, I think one of the major changes which is going to come in the Indian economy business is that government is trying to promote entrepreneurship. That's a very good thing for all the professionals also, because when entrepreneurship increases, the overall business scenario increases, and we as professionals get better opportunity also. So SME segment is a vital role in times to come. And so please involve yourself in all the aspects of SME, including the valuation part, obviously, including the valuation also. Because till now, valuation was related to, a lot of big companies. But going forward, I think now valuation will be a part for small companies because of multiple reasons. Yes, obviously, for the compulsion of law is there, we agree. But apart from compulsion of law, I think the clients will be educated now. The clients will be aware now that valuation is an important angle, and the criteria of valuation are something different from what they believe in. And therefore, in going forward, they will understand and understand the complexities involved in the valuation. So a few of the factors which we have to consider in the ecosystem, which I mentioned, that the ecosystem of entrepreneurship is increasing in India day by day, and therefore SMEs are, SME is the base where the people will start. From SME they become big. So that is why I say the future prospects is good. Then the second angle is the demographic change which we are observing in terms of the generation of people who are coming in, the second, the third, and the fourth generation. What is that demographic change which we are feeling? You must be feeling it in your home also, where we now believe that the second and third generation people are not interested in carrying on their family businesses. The YTF, the YouTube, the Facebook generation are now looking for new, better, adventurous avenues rather than following the family business and carrying on their family business, which they find is unattractive, very boring, not much of risk, not much of adventure into it. So why am I discussing this here? Why? Because the reason is that it is giving you an opportunity, friends, to look for all these kind of businesses who do not have a succession plan. And when you find these kind of businesses where you don't have a succession plan coming up, then the ideal consulting which you should give to these kind of family businesses, they should sell out the business. That is the only way out. And selling out the business is when you sell out the business, the ideal way is you have to value these companies. So therefore, valuation opportunities is going to come. So apart from the economic factor, we need to consider the social changes happening in the culture, society, and the culture also. And therefore, as a professional, I think a lot of opportunities are coming in, and especially after the Insolvency Act, which has come in, we'll see a lot of opportunities in the valuation of small companies, because insolvency has brought us a platter of a lot of small companies available for sale, and you would not have found these companies available for sale in maybe 5 years back. You could not identify a small company situated in a far distant location, and if you have an investor who wants to invest in those companies, that would not be a possibility. But today it is a possibility. Because of the insolvency, you'll find small companies coming in the public domain for sale in a very open and a transparent manner at times. So therefore, the valuation opportunities will also come in. When you have a client who wants to invest in such kind of companies, you need to value. So therefore, I think a lot of valuation opportunities can in the SME segment. So the technique which is used for valuation of such companies is simple: the DCF and the comparable transaction, which we have been all understanding so far. So not much of change in that. But when we apply DCF, I think what we need to consider is the issues which will affect the valuation issues, the market data, whether the books which they are forecasting is representing facts or not, or a lot of these companies are dependent upon single person, and that has to be taken into consideration, because SME segment we know that are driven by few individuals. So all these factors are very important when we value such kind of companies. We need to understand whether what is the reality. So based on the reality, because these are not done only as a formality. You agree, when we're doing it just as a formality, then it's fine. But if you are doing it for investment purpose, then I think a lot of factors have to be considered. So valuation of SME, DCF factor. From exam point of view, remember one point thing. When we value such kind of companies, the small and medium enterprises, private limited companies, one factor has to be considered, and that factor is known as DLOM. Very important. Discount for lack of marketability. Discount for lack of marketability. Discount for lack of marketability. Remember, very important. Discount for lack of marketability. Now, what is that discount? Basically, it is a discount given for illiquidity. Discount given for illiquidity. Right. So, discount given for illiquidity is a factor to be considered. And practically also, when you do the valuation, you can always apply this discount for lack of marketability, which ranges from 15 to 25%. So how do you do that? When you calculate the value of shares, from that value of share, you can further give a discount for 15 to 20% to get the actual value, especially for a private limited company. Last, we come to valuation of investment entities. And what is our investment entities? It's a holding company. And holding company where the investment is done in so many other companies. So the valuation of that holding company could be based on the valuation of those companies where the funds have been invested. So the one exam question that will come is that valuation will be done on the fair value basis of all the companies. So the value of holding company would be the sum of all the fair value of the investment. That is a very simple way and very logical to determine the value of the holding company. And that is given in the Ind AS also. All the Ind AS and the IFRS will always talk about the fair value. So based on the fair value of the investments, we can do the valuation of such companies. And lastly, we come to valuation of insurance companies. I think insurance companies are valued. Only one question from the exam perspective. They are valued based on price to book value. It's not only about insurance companies, but all the companies like in the nature of banking and NBFCs, they are based on this concept of price to book value, which is the most common method for evaluating such kind of company spends. So this, in this way, we have covered all the topics under the valuation in the specific situation, covering from the stress asset, the startups, the SME, the cyclical firms, the 9 methods of startups, and valuation of investment entities, and so on. If you have any questions, please raise. Otherwise, we will shift to the question session. Okay, so let me put up some questions. Yeah, 4 is the correct answer. Right. Yes, third is the correct answer. Yes, third is the correct answer. Yes, fourth is the correct answer. Simple one, yes, C is the correct answer. So correct answer is second. Second is the correct answer. Yes, second is the correct answer. Yes, D is the correct answer. Yes, the correct answer is 4. 4 is the correct answer. 4. I think everybody should get it correct. The correct answer is fair value. Fair value, not book value. We had discussed this. It has to be done on fair value. I'll throw up one question for all of you, and I would request that you should solve this question. Let's say if there's a question on the screen where we have to calculate the value of the brand. So I give you 5 minutes to solve this question, and let me see how many of you get it correct on Excel, and give me the answer with all the concepts which you have studied, understood, applying all the formulas. Let me see how many of you get it correct. It's an 8-mark question as in exam. 8-mark question as in exam. So 5 minutes, and then after 5 minutes, I'm going to solve it on Excel. So Mr. Ranjan and Mr. Sumit has given me a few answers. Last 1 minute and then we start. Okay, so I'll show the answer on the screen. So is the answer, friends? So I have taken discounted. There are two discounted 15, 10, growth rate is 4%. If you can see the question also, I think these are the data which is given. And then we have the 5-year cash flows 1, 2, 3, 4, minus 7.5, minus 4, 6, 8, 10. So these were the 5-year cash flows, right? And the first step, what we did was present value of free cash flow for the growth period. This is the formula which we applied. NPV at rate of 15% for the 5-year growth cash flows.
Sir, why is it not for 4 years?
It is given for 5 years, sir. In the question, it is given for.
Yeah, it is there. In 5th year, it will be go some increment of 4%, and then
That is after 5 years.
that and discounted
That is
rate also
after,
10. Discount rate also 10% in 5 year.
no, after 5 years, it is 10%. For first 5 years, it is 15%. Right? So based on this, we have calculated the cash flow for the present value for the growth period. Next is the terminal value. So terminal value is always based on last year cash flow, that is 10. We have applied the growth rate of 4%. and applying the formula for perpetuity. And then we get the answer of the terminal value. Okay. So once we have the terminal value, what we have to do is consider the present value of terminal value. So present value of terminal value discounted by the 5th year rate at 15%. Present value of terminal value discounted by 15% at the end of 5th year. So we have the present value of terminal value, the present value of free cash flows, and when we
What
add
is cell E8, sir?
Pardon?
What is that cell E8? That terminal?
E8 number of years. This is E8, 5th year.
Okay.
We have applied the discounting rate for the 5th year. So the value of business is the adding of present value of free cash flow plus present value of terminal value, 90.12, and the total amount paid is 108 lakhs. Total amount paid is 108 lakhs. So the difference between the amount paid and the value of business would be the value of brand.
What about the development cost? Are you not considered the development cost?
Where is the development cost?
It is given in the problem. That is a development cost effect.
That is already being considered.
Or it is considered development cost was 7.5 lakhs and 4 lakhs, no?
No, that is not a yes, that is the negative cash flow which we have considered, sir. This is the see in the cash flows minus 7.5 and minus 4.
Okay.
The terminal cash flow is discounted at 10% or 15%?
10. No, terminal cash flow is discounted at 15%, but for calculation of terminal value it is 10. But for calculation of present value it is 15.
Okay.
And then cash flow started from 6th, 8th and 10th, from 3rd year onwards.
Yes.
That was our mistake. We considered from 1st year.
Yes.
So first 2 years are in the development phase, then it started generating revenue from the 3rd year. Correct?
Yes. Correct.
So our basic assumption was wrong.
17.88 cents. Right, and so this is a practical question which we asked in the part, and we have covered so many areas today, from intangible to.
Sir, are you going this calculation in the PDF or through the study materials? Are you providing this one?
I'll send it on WhatsApp, sir.
Yeah, please. Otherwise, we cannot follow all these things.
Yeah, sure. I'll do that. Right. So, thank you, friends, for attending today's session, and I hope if you have any query, I'm there on the WhatsApp group. You can always send me a message. I'll try to answer it on the WhatsApp page.
Thank you, sir.
Yeah. Thank you, Mr. Rohit.